Chapter 1. The Paperboy. Picture a boy on a bicycle before dawn. The streets of Omaha are still dark, the air cold enough to see your breath, and the canvas bag slung over his shoulder is heavy with newspapers. He's 10 years old. His name is Warren Buffett, and he's counting. Not counting the papers. He already knows how many he has. He's counting something else, something most 10-year-olds never think about. He's counting how many routes he can handle at once, how many papers he can deliver in an hour, how much money each route generates per week, and most importantly, how much money that money could make if he never spent it. This is 1940. The world is at war, though America hasn't joined yet. In Omaha, life moves at a different pace. The streetlights cast long shadows. Porches creak under his feet. He folds each paper with the same motion, tosses it with the same arc, and moves to the next house before the paper lands. Efficiency isn't just a word to him. It's a feeling, a rhythm. Mandersiet. His father is a stockbroker turned congressman, a man of principles so rigid they sometimes bend the family finances. Howard Buffett believes in gold, hard money, and telling the truth, even when it costs him elections. Warren inherits the principles, but not the rigidity. Where his father sees moral absolutes, Warren sees patterns, numbers that tell stories, systems that either work or don't. The paper route is Warren's first laboratory. He buys his first route for himself, then realizes something most adults miss. One route is a job, but 5 routes is a business. He acquires more routes. He hires friends to deliver them. He keeps the margin. By the time he's 13, he's pulling in more money than his teachers. But here's what matters. Here's what separates this paperboy from every other paperboy on every other street in America. Warren doesn't spend the money. He saves it, obsessively, completely. And he doesn't just save it. He invests it. At 11 years old, he buys his first stock. 3 shares of City Service Preferred at $38 a share. He buys 3 shares for himself and 3 for his sister Doris. The stock drops to $27. Doris reminds him of this every single day. Warren learns what fear feels like when it's attached to money. He learns what responsibility feels like when someone else's money is involved. He holds on. The stock climbs back to $40. Warren sells. He's relieved. He's made a small profit. He's learned his lesson about buying stocks that drop. Then the stock keeps climbing. It goes to $200 a share. Warren learns a different lesson. A bigger one. Patience isn't just a virtue. It's a competitive advantage. Selling too early can cost more than buying too late. He never forgets this. At night, in his small bedroom above the family living room, Warren reads. Not comic books, not adventure stories. He reads books about money, about business, about how fortunes are made and lost. He checks out every book on investing from the Omaha Public Library, some of them twice. He's looking for something, though he doesn't yet have the words for what it is. He's looking for a system, a way of understanding the world that makes sense of all the noise. The newspaper routes give him something more valuable than money. They give him proof that systems work. That consistency compounds. That small advantages, repeated daily, become large advantages over time. His mother, Layla, doesn't understand him. She's a woman of volatile moods, capable of withering criticism that lands on Warren without warning or pattern. He learns to navigate around her storms, to find safety in numbers and facts, in things that don't change based on someone else's emotions. He becomes skilled at reading people while keeping his own feelings locked away. His friends think he's odd. He doesn't play sports. He doesn't care about fitting in. He cares about making money, and he talks about it constantly, with a frankness that makes adults uncomfortable. At 12, he declares he'll be a millionaire by 30. If he isn't, he says, He'll jump off the tallest building in Omaha. No one knows if he's joking. He probably isn't joking. The paper routes continue for years, before school, after school, weekends, holidays. While other boys play baseball, Warren delivers papers. While other boys go to dances, Warren calculates compound interest in his head. He's not suffering. He's not lonely. He's found something most people search for their entire lives. He's found the thing he's built to do. By the time he's 14, he's saved more than $1,000. In 1944, that's real money. That's down payment on a house money. That's change your life money. And Warren is ready to change his life. But to understand what he does next, you have to understand something about teenage boys and pinball machines. Chapter 2. The Pinball Hustler. The pinball machine sits in the back corner of a barber shop on the south side of Omaha. It's a Wilson model, all chrome and lights, with a coin slot that jingles every time someone feeds it a nickel. Warren Buffett is 14 years old, standing in front of this machine with his friend Don Danley, and he's doing math in his head. Not the kind of math they teach in school, the other kind. The kind that counts nickels per hour, multiplied by hours per day, multiplied by machines per location, minus the cost of the machine, minus the cut for the barbershop owner. The kind of math that tells you whether something is a business or just a hobby that loses money. Warren and Don have $25 each. Together, they have enough to buy a used pinball machine. They find one, they repair it, they paint Wilson Coin-Operated Machine Company on the side in professional-looking letters. Wilson is Don's middle name. It sounds legitimate, established, like a company that's been around for decades, not two teenagers with a dream and a used pinball machine. They approach a barbershop owner. Warren does the talking. He explains that the machine will bring in customers, keep them entertained while they wait. The shop gets half the proceeds for doing nothing except having the machine in their space. The owner says yes. The first day, the machine makes $4. Warren and Don split it with the shop owner. $2 for the business. $1 each for two teenagers who just learned that money can work while you sleep. That assets generate income. That if one machine makes $2 a day, 7 machines make $14 a day. That $14 a day is close to $100 a week. That $100 a week in 1944 is more than most men in Omaha make working full-time. Within months, they have 7 machines in 7 locations. Warren's still delivering newspapers before dawn, still going to school, still reading investment books at night. But now he's also checking on pinball machines, collecting coins, negotiating with barbershop owners. He's learning about routes and territories, about maintenance and margins, about the difference between revenue and profit. More importantly, he's learning about scalability. One newspaper route requires one Warren Buffett on one bicycle at one time. But pinball machines work without him. They sit in barbershops across Omaha, collecting nickels, generating income, while Warren is somewhere else entirely. This is leverage. This is the thing that separates the rich from the comfortable. His father doesn't approve. Howard Buffett believes in honest work, in earning your money through labor and sweat. Pinball machines feel like gambling to him, like something slippery and morally ambiguous. But Warren isn't interested in moral ambiguity. He's interested in systems that work, and this system works. The machines break down. Warren learns to fix them. The barbershops want a bigger cut. Warren learns to negotiate. Other kids try to start competing companies. Warren learns about barriers to entry, about first mover advantage, about relationships and reputation. Every problem is the lesson. Every lesson is worth more than the money. By the time Warren is 15, he's making more than his teachers. Significantly more. He files his first tax return. He deducts his bicycle as a business expense. After all, He uses it to service his pinball empire. The IRS allows it. Warren learns that the tax code rewards people who own businesses differently than people who just work for them. He buys a 40-acre farm in Nebraska for $1,200. He's 15 years old, and he's a landlord. He rents the farm to a tenant farmer. The farm generates income. Passive income. Money that arrives whether Warren does anything or not. He's beginning to understand something profound. Something most people never grasp. Remember, money isn't just something you earn. It's something you deploy. And how you deploy it matters more than how hard you work for it. Work. At school, Warren is invisible. Not unpopular. Invisible. He doesn't play sports. He doesn't join clubs. He speaks rarely in class. And when he does, it's usually to correct a teacher's math. He has a few close friends. Boys like himself who think about business and money and systems. To everyone else, he's just the strange kid who talks about compound interest at lunch. But he doesn't care. He genuinely doesn't care, because he's living in a different timeline than his classmates. They're living in the present, worried about dances and football games and who likes whom. Warren is living 5 years ahead, 10 years ahead, calculating what his money will become if he never touches it, if he lets it compound, if he keeps finding businesses that generate more money to reinvest. The pinball business eventually sells. Warren and Don get their money out, multiplied several times over. By the time Warren graduates high school, he's accumulated the equivalent of what many adults save over a lifetime. He's 17 years old with over $90,000 in today's money. He doesn't want to go to college. He wants to start investing full-time. His father insists. Education matters, Howard says. Warren resents it, but he goes. He applies to Harvard Business School. Harvard rejects him. Years later, Warren will call it one of the best things that ever happened to him, because the rejection sends him somewhere else, somewhere that will change everything. But before that happens, Warren spends 2 years at the University of Pennsylvania, then transfers to the University of Nebraska. He rushes through his degree in 3 years total. He's impatient. He's ready. He has money and knowledge and an unshakable belief that he understands something important about how the world actually works. What he doesn't yet have is a teacher. Someone who can show him that everything he's learned so far is just the beginning. That buying businesses and pinball machines and farmland is one kind of investing, but there's another kind. A purer kind. A kind that requires nothing but patience and intelligence, and the ability to read financial statements like other people read novels. He's about to find that teacher. And when he does, everything. The paper routes, the pinball machines, the early morning deliveries, the obsessive saving, all of it will click into place like tumblers in a lock. Chapter 3. The Rejected Son. The rejection letter from Harvard Business School arrives in the spring of 1950. Warren is 19 years old, sitting in his childhood home in Omaha, holding a piece of paper that says he's not good enough, not polished enough, not Harvard material. He's crushed, not because Harvard matters in itself, but because Harvard is supposed to be the next logical step. The place where serious people go to learn serious things about business. He's planned for this, prepared for this, and they've looked at his application, his age, his accomplishments, his transcript, and said no. The interview went poorly. Warren knows this. He was nervous, awkward. He couldn't make small talk with the alumni interviewer, couldn't perform the social rituals that schools like Harvard use to separate the insiders from the outsiders. He talked about stocks and compound interest, when he should have talked about leadership and teamwork. He was himself, and himself wasn't what they wanted. Years later, Warren will describe this rejection as one of the luckiest breaks of his life. But standing in his parents' house in Omaha, holding that letter, he doesn't feel lucky. He feels like he's failed at something that should have been easy. His father tries to console him. There are other schools, other paths. Howard has always believed that education is important, but he's never believed that pedigree matters more than character. Warren hears the words but doesn't feel them. He's spent his entire life being smarter than the people around him, and now someone has told him he's not smart enough. He picks up a course catalog, Columbia Business School. He's flipping through it without much hope when he sees two names that make his heart stop. Benjamin Graham, David Dodd. They're teaching at Columbia, both of them. The authors of Security Analysis, the book that changed everything for Warren when he read it at 19. This isn't just any book. This is the book. 600 pages of dense financial analysis that most people find unbearably boring. Warren read it the way other people read adventure novels. He read it twice. Then he read it again. Graham and Dodd didn't just explain how to analyze stocks. They explained a philosophy, a way of thinking about investing that was methodical, mathematical, and completely removed from emotion and speculation. Graham called it value investing. The idea was simple but radical. A stock isn't just a ticker symbol or a gamble on the future. It's a piece of a real business, and every business has an intrinsic value based on its assets, its earnings, its future cash flows. Most of the time, the market gets this value approximately right. But sometimes, often actually, the market gets it wrong. Fear drives prices too low. Greed drives them too high. And in those gaps between price and value, fortunes can be made. Warren reads the names again. Benjamin Graham, David Dodd, teaching at Columbia. Not writing about investing from some distant ivory tower, but teaching, in person, to students. He applies to Columbia immediately. He writes to Graham directly, mentions the book, explains his obsession with value investing. He doesn't know if Graham will even read the letter. He doesn't know if Columbia will accept him where Harvard rejected him. But for the first time since the rejection, he feels something like hope. Columbia says yes. Warren takes the train to New York in the fall of 1950. He's 20 years old. He's never lived in a big city. He finds a small apartment, unpacks his few belongings, and shows up to his first class with Benjamin Graham like a pilgrim arriving at a shrine. Graham is 56 years old, distinguished, eloquent, with a mind that moves through financial statements like a surgeon through anatomy. He's already legendary on Wall Street, already wealthy, already semi-retired from his investment firm. He teaches because he likes teaching, because he believes the principles of value investing should be shared, not hoarded. Warren sits in the front row. He's read everything Graham has written. He knows the book better than Graham does. He's memorized whole passages. When Graham asks questions, Warren answers. When Graham presents a case study, Warren has already analyzed it in his head, calculated the intrinsic value, determined whether it's a buy or a pass. The other students find Warren annoying. He dominates the discussion. He challenges Graham's examples, not argumentatively, but enthusiastically, like a jazz musician trading solos with his idol. Graham is amused, then impressed, then genuinely interested in this intense young man from Omaha, who seems to have absorbed everything Graham believes and made it his own. After class, Warren lingers. He asks more questions. Graham stays late to answer them. They talk about specific stocks, specific situations. Warren mentions a company he's been studying. Graham mentions one he's been watching. They're speaking the same language. And for Warren, who has spent his entire life feeling slightly out of the phase with everyone around him, this is everything. He takes every class Graham teaches. He takes David Dodd's classes too. Dodd is quieter than Graham, more methodical, but just as rigorous. Together they're teaching Warren not just how to analyze companies, but how to think about risk, about margin of safety, about the difference between investment and speculation. Graham introduces a concept that becomes central to everything Warren will do later: margin of safety. The idea is this: you can analyze a company perfectly, Calculate its intrinsic value down to the penny and still be wrong. The future is uncertain. Your assumptions might be off. The company might face unexpected problems. So you don't just buy stocks that are worth what they're trading for. You buy stocks that are trading for significantly less than they're worth. 40 cents on the dollar, 50 cents at most. That gap, that margin, is your safety net. Warren absorbs this. He internalizes it. He starts looking at stocks the way Graham taught him. He's not looking for the next big thing, the hot company everyone's talking about. He's looking for the boring companies no one is paying attention to, the ones trading below their asset value, the ones where you can buy $1 for 50 cents and wait for the market to wake up. In Graham's class, Warren gets the only A+ Graham has ever given. Years later, Graham will say that Warren was the best student he ever had. But at the time, in 1951, Warren is just a student, trying to learn everything he can from a teacher he reveres. He graduates from Columbia in 1951 with a master's degree in economics. He wants to work for Graham. He asks directly. Graham says no. Not because Warren isn't good enough, because Graham's firm, Graham Newman, doesn't hire anyone who isn't Jewish. This is 1951. Wall Street is divided along ethnic and religious lines in ways that seem incomprehensible now, but were simply the way things worked then. Graham himself faced discrimination early in his career. Now he runs a firm that only hires from the same community that gave him his start. Warren understands, or tries to, but he's devastated. Again, first, Harvard rejected him. Now his hero won't hire him. He's 21 years old, armed with more knowledge than most professional investors, and he has nowhere to go. So he goes home, back to Omaha, back to his father's house. He takes a job at his father's brokerage firm, Buffett Partnership, doing the kind of work that bores him, selling stocks to clients, making cold calls, trying to convince people to buy things they don't understand and probably shouldn't own. He hates it. He's good at analyzing companies, but terrible at selling. He doesn't have the salesman's gift for enthusiasm about mediocre opportunities. He can't pretend something is a good investment when it isn't. His father worries that Warren won't make it in the business, that he's too honest, too blunt, too focused on being right instead of being liked. But Warren keeps studying. He keeps reading annual reports. He keeps applying Graham's principles to every company he can find. He's waiting, preparing, building his knowledge like someone stockpiling ammunition for a war that hasn't started yet. And then, in 1954, Benjamin Graham calls. There's an opening at Graham Newman. Is Warren still interested? Warren doesn't hesitate. He doesn't negotiate salary. He packs his belongings, says goodbye to his new wife Susie. They married in 1952, and moves to New York. He's 24 years old, and he's about to work for his hero. He's about to learn things you can't learn from books. Things about temperament and discipline and the emotional side of investing that matters more than all the analysis in the world. He's about to discover that even great teachers can be wrong about certain things, and that sometimes the student has to learn when to follow the master's wisdom and when to go beyond it. Chapter 4. The Graham Years. The offices of Graham Newman Corporation occupy a modest space at 52 Wall Street. Nothing fancy. No mahogany panels or expensive art. Just desks and filing cabinets and stacks of annual reports. Benjamin Graham doesn't believe in spending money on appearances. He believes in spending money on stocks trading below their liquidation value. Warren Buffett shows up on his first day in 1954 like someone reporting for duty in a war he's been training for his entire life. He's 24 years old. He's making $12,000 a year. He would have done it for free. Graham runs the firm with his partner Jerry Newman. They manage about $4 million, which sounds small but represents real money in 1954. More importantly, They manage it according to strict principles. Graham's principles, the ones Warren has memorized and internalized and dreamed about since he first read security analysis in college. The method is simple, brutally simple. Graham looks for companies trading below their net current assets, their cash and inventory, and receivables minus all their liabilities. If you can buy a company for less than its liquidation value, you can't lose. Even if the business is terrible, even if management is incompetent, the assets are worth more than the stock price. Eventually, the market corrects this. Eventually, you make money. Graham calls these cigar butt stocks. There's one puff left in them, one last bit of value to extract. You pick them up off the ground, take that last puff, and move on to the next one. It's not glamorous. It's not exciting. But it works. Warren throws himself into the work. He reads annual reports the way scholars read ancient texts. He calculates working capital. He identifies companies trading at huge discounts to their asset values. He brings these ideas to Graham, who either approves them or explains why they don't meet the criteria. Every rejection is a lesson. Every approval is a validation. But something strange starts happening. Warren begins to notice things Graham doesn't care about. The quality of the business, the strength of the management, the competitive position. Graham taught him to ignore these things, to focus purely on the numbers, on the quantitative factors that can be measured and verified. But Warren keeps seeing situations where a slightly better business, trading at a slightly higher price, might be a much better investment over time. There's a company called Western Insurance Securities. Graham analyzes it using his standard criteria. The numbers work. The assets are there. But Warren notices something else. The company owns a growing insurance business. The management is smart. The competitive dynamics are favorable. This isn't just a cigar butt with one puff left. This might be something more. Graham doesn't see it, or doesn't care. He sticks to his method. Buy cheap, sell when it reaches fair value. Move on. Don't get attached. Don't fall in love with the business. Don't try to predict the future. The numbers are the only truth. Warren respects this deeply. Graham is his teacher, his mentor, his hero. But a small seed of doubt is planted. Not doubt about Graham's intelligence or integrity. Doubt about whether Graham's method is the only method, whether there might be a better way. The daily routine at Graham Newman is methodical. Warren and the other analysts screen for companies meeting Graham's criteria. They read the annual reports. They visit companies occasionally, though Graham doesn't put much stock in management meetings. Managers lie. They exaggerate. They tell you what you want to hear. The numbers don't lie. Trust the numbers. Warren learns discipline at Graham Newman. The kind of discipline that lets you look at a popular stock everyone loves and say no. The kind that lets you buy something everyone hates and hold it while people tell you you're crazy. Graham has this discipline in his bones. He lived through the 1929 crash. He lost almost everything. He rebuilt by following rules, by never letting emotions override analysis. One day, Graham asks Warren to analyze Geico, the government employees insurance company. It's a small auto insurer that sells directly to customers instead of through agents. Graham Newman owns a large stake. Graham wants to know if they should buy more. Warren dives in. He studies the business model. He realizes that by eliminating agents, Geico has a cost advantage over every other auto insurer. They can charge lower premiums and still make higher profits. This isn't a cigar butt. This is a fundamentally superior business with a moat around it. A competitive advantage that compounds over time. Warren gets excited. Really excited. He takes the train to Geico's headquarters in Washington on a Saturday. The office is closed. He pounds on the door until a janitor lets him in. He asks if anyone is working. The janitor mentions that a young executive named Lorimer Davidson is upstairs. Warren finds Davidson. introduces himself, says he's from Graham Newman. Davidson spends 4 hours explaining the insurance business to this intense young man from Omaha. How premiums work, how float works, the money customers pay up front that the company can invest before it pays out claims, how Geico's model is different and better than everyone else's. Warren goes back to New York understanding something profound. This is the kind of company worth owning forever, not for one puff, for the whole pack, for decades. This is what great investing looks like, finding a superior business and holding it while the advantage compounds. But Graham doesn't think this way. Graham is getting older. He's in his 60s now. He's wealthy. He's tired. He wants to wind down, pursue his other interests, music, languages, philosophy. He's planning to close Graham Newman. He's already told his investors. Warren senses his time is running out. He's learning everything he can, but he's also realizing that his future isn't in New York, working for someone else. His future is something else. Something he can't quite see yet, but can feel approaching. Graham is teaching him to be conservative, to demand a margin of safety, to never overpay. These lessons are invaluable. They'll protect Warren from the catastrophic mistakes that destroy most investors. But Graham is also teaching him, accidentally, by example, that being too conservative has a cost. That passing on good businesses because they're not cheap enough means missing the truly great opportunities. In 1956, Graham announces he's closing the firm. He's done. He's moving to California to teach and write and live the life he wants. He offers Warren a partnership if Warren wants to stay in New York and keep the firm going. It's a generous offer, a vote of confidence. Most people would say yes. Warren says no. He's 25 years old. He has about $174,000 saved, built from his early ventures and his salary, and his own investments following Graham's methods. He knows what he wants to do. He's going home to Omaha. He's going to start his own investment partnership. He's going to take everything Graham taught him and add the things he's starting to figure out on his own. Graham is surprised but supportive. He gives Warren his blessing. They shake hands. Warren leaves New York, leaves Wall Street, leaves the traditional path to success in finance, and heads back to the place he's always understood best. Omaha, Nebraska, where the distractions are fewer, where the costs are lower, where he can think clearly and invest patiently and build something that belongs entirely to him. He doesn't have a plan beyond the basic structure. He'll start a partnership. He'll manage money for friends and family. He'll charge a fee based on performance, not assets. He'll follow Graham's principles, but adapt them, evolve them, make them his own. What he doesn't know, what he can't possibly know in 1956, is that he's about to embark on the greatest investment track record in history. That the small partnership he's forming in his childhood bedroom will become Berkshire Hathaway. That the principles he's learning from Graham, combined with the insights he's developing on his own, will make him not just wealthy, but legendary. But that's years away, decades away. Right now, he's just a 25-year-old heading home with a modest stake and a head full of ideas. He's about to find out if what he believes about investing is actually true. If the discipline and patience and focus he's cultivated can work in the real world with real money over time. The Graham years are over. The Buffett years are about to begin. Chapter 5. The Return to Omaha. Warren Buffett comes home to Omaha in the spring of 1956 with $174,000 to his name and no job. He's 25 years old. He has a wife and 2 young children. His father thinks he should get a real position somewhere. His father-in-law thinks he's crazy. Most of Omaha thinks he's that odd Buffett kid who used to deliver newspapers and now does something complicated with stocks in New York. He rents a modest house on Underwood Avenue for $175 a month. 3 bedrooms, a small den. Nothing special. This den will become the headquarters of what he's about to build. No secretary, no office downtown, no overhead. Just Warren and a telephone and stacks of annual reports piled on every available surface. He has a simple idea. He'll manage money for people he knows. He won't charge a management fee. Instead, he'll take a quarter of the profits above a 6% return. If he makes people money, he makes money. If he doesn't, he doesn't. The incentives are perfectly aligned. His interests and his partner's interests point in exactly the same direction. But first, he needs partners. He needs people willing to give money to a 25-year-old with no track record of managing other people's capital. He starts with family. His sister Doris and her husband, his Aunt Alice, his college roommate, his father-in-law eventually, after significant persuasion from Susie. Small amounts, $5,000 here, $10,000 there. On May 1st, 1956, Warren creates Buffett Associates, Limited 7 limited partners. Total capital, $105,000. Warren contributes $100 of his own money. It's not that he doesn't have more, he does, but he wants to keep his own capital separate, available in case opportunities arise that don't fit the partnership's criteria. The terms are unusual. Warren has complete control over investment decisions. The partners can't see what he's buying. They get an annual letter explaining the performance and the philosophy, but no details. No quarterly updates, no transparency into individual positions. If they don't trust him, they shouldn't invest with him. If they do trust him, they don't need to see every move he makes. Most money managers in 1956 would never propose such terms. But Warren isn't interested in managing money for people who need to watch over his shoulder. He's interested in investing with absolute focus, without the distraction of explaining every decision or managing other people's emotions about short-term fluctuations. His pitch is simple. He tells potential partners that he expects to beat the Dow Jones Industrial Average by 10 percentage points per year over time. Not every year. Some years he might lag. But over a decade, he's confident he'll deliver returns significantly better than the market. He won't tell them how he'll do it. He won't tell them what he's buying. But he'll do it. Several people say no. They want more information, more transparency, more conventional arrangements. Warren lets them walk away. He's not trying to build an empire. He's trying to build a track record. Quality over quantity. Partners who understand and trust his approach. The den becomes his office. He reads annual reports for hours each day. Moody's manuals. Standard & Poor's stock guides. He's looking for the same things Graham taught him to look for. Companies trading below their liquidation value. Situations where the assets are worth more than the market price. But he's also looking for something else now. Better businesses. Companies with competitive advantages that might be worth holding longer than Graham would have held them. He finds National American Fire Insurance Company. The stock is trading for a fraction of its book value. The company has been mismanaged, but the assets are solid. Warren starts buying. He accumulates a position. He waits. The market eventually recognizes the value. He sells at a significant profit. He finds Sanborn Map Company. They make detailed maps for insurance companies, showing every fire hydrant, every building, every relevant detail insurers need to assess risk. It's a good business, but a declining one. Insurance companies are starting to create their own maps. The stock trades around $45 per share. But Warren notices something in the annual report. Sanborn owns a large portfolio of securities. Stocks and bonds they've accumulated over decades. These securities alone are worth $65 per share. Think about that. The market is valuing Sanborn at $45. The securities they own are worth $65. The market is saying the entire map business, the operating company, is worth negative $20 per share. that the map business is worse than worthless. Warren knows this is wrong. The map business might be declining, but it's still profitable. It's still generating cash. At worst, it's worth zero, which means the stock, at $45, is selling for less than 2/3 of just the investment portfolio, ignoring the operating business entirely. Warren buys a lot. He accumulates enough shares to make demands. He pushes the board to distribute the investment portfolio to shareholders. Some board members resist. Warren keeps pushing. Eventually, they relent. Shareholders get their securities. Warren makes a large profit. More importantly, he demonstrates something. He's not just a passive investor finding cheap stocks. He's an active owner who will push for change when companies aren't serving shareholder interests. His partners are thrilled. The returns are exceptional. Better than the Dow. Better than 10 percentage points above the Dow. In the first year, the partnership is up 4%, while the Dow is down 8.4%. A 12 percentage point differential, exactly what Warren promised. More people want in. Friends of friends, Omaha business people who hear about this young guy generating remarkable returns. Warren starts more partnerships, different groups of investors. By 1959, he's running 6 separate partnerships, each with slightly different investors, but all following the same strategy. The house on Underwood Avenue gets more crowded. Annual reports overflow from the den into the living room. Susie manages the household, while Warren manages money. Their children, Susie, Howard, and Peter, learn to navigate around piles of financial documents. This is normal to them. Dad reads annual reports the way other dads read newspapers. Warren lives simply. He drives an old Volkswagen. He wears inexpensive suits. He eats at the same steakhouse, orders the same steak. He's not interested in luxury. He's interested in compound interest. Every dollar he spends is a dollar that can't compound into many dollars over decades. The math is simple. If he can compound money at 25% per year, every dollar he doesn't spend today becomes $9 in 10 years. $17 in 12 years. The opportunity cost of consumption is staggering when you calculate it properly. But he's not miserly. He's generous with his time, especially with people who want to learn about investing. He teaches an adult education class called Investment Principles at the University of Omaha. He charges nothing. He just wants to share what he knows. Some of his students become lifelong friends. Some become investors in his partnerships. The investment philosophy is evolving. He's still using Graham's methods, looking for companies trading below liquidation value, demanding a margin of safety. But he's starting to weight quality more heavily, starting to think about businesses he might want to hold for years instead of just until they reach fair value. The cigar butt approach works, but it's labor intensive. You find a bargain, buy it, wait for it to work, sell it, and start over. You're constantly searching for new ideas. But what if you could find businesses so good you didn't have to sell them? Businesses that got more valuable every year, where the intrinsic value that kept growing, compounding, building on itself? That would be easier, more efficient, and potentially more profitable over long periods. Warren hasn't fully formed this thought yet, but it's growing in the back of his mind, germinating, waiting for the right catalyst to make it explicit. That catalyst is coming. His name is Charlie Munger, but Warren doesn't know about Charlie yet. Right now, in the late 1950s, Warren is just focused on finding good investments, generating good returns, and proving that what he learned from Graham works in the real world here. The partnerships keep growing. The returns keep compounding. Warren keeps reading, analyzing, thinking. He's building something, not just wealth, though he's definitely building wealth. He's building a reputation, a track record, evidence that his way of thinking about investing isn't just theory. It's reality. And in 1962, he's going to make a decision that changes everything. He's going to buy a textile company called Berkshire Hathaway. Not because it's a great business. It isn't. But because it's cheap, and he's angry, and sometimes even Warren Buffett makes mistakes driven by emotion rather than pure logic. But we're getting ahead of ourselves. First, we need to understand the machine he builds in Omaha, the Buffett Partnership. 13 years of extraordinary returns, 13 years of discipline and patience, and saying no to almost everything in order to say yes to the few things that truly matter. Chapter 6. The Buffett Partnership. By 1962, Warren Buffett is managing 7 separate partnerships with different groups of investors. The paperwork is becoming absurd. Different letters to different partners, different accounting for each entity. Same strategy, same investments, but multiplicative administrative headaches. So he consolidates, merges all 7 partnerships into one. Buffett Partnership, limited one entity, one set of books, one annual letter. Simpler, cleaner, more efficient. This is how Warren thinks about everything. Eliminate the unnecessary. Focus on what matters. The consolidated partnership starts 1962 with $7.2 million in assets. 90 partners. Most are from Omaha. Doctors, business people, friends from his Dale Carnegie public speaking course, his sister, his aunt, his mother-in-law. People who trust him with money they can't afford to lose, which makes Warren even more careful than he'd be with his own capital. The terms remain unusual. Warren takes 25% of profits above a 6% threshold. Below 6%, he takes nothing. The partners can add money on January 1st each year. They can withdraw money with 12 months' notice. But they can't see the portfolio. Can't know what Warren is buying or selling. If this bothers them, they shouldn't be partners. It doesn't bother them because the returns are extraordinary. In 1962, when the Dow drops 7.6%, the partnership gains 13.9%. In 1963, the Dow is up 20.6%. The partnership is up 38.7%. In 1965, the Dow gains 14.2%. The partnership gains 47.2%. Year after year, Warren is beating the market by enormous margins. He's doing it through 3 types of investments. He calls them generals, workouts, and controls. The generals are Graham-style, undervalued stocks, companies trading below their intrinsic value, where Warren expects the market to eventually recognize what they're worth. He might hold these for a few months or a few years. No timetable except waiting for value to be realized. Workouts are special situations, mergers, liquidations, reorganizations, events with a defined timeline where Warren can calculate the probability of different outcomes and the expected value of each. These are less dependent on the overall market. They work in bull markets and bear markets. They are mathematical, actuarial, the kind of thing an insurance company might do if insurance companies invested in stocks. Controls are different. These are companies where Warren buys enough stock to influence or control management, where he can affect outcomes rather than just predicting them. Sanborn Map was a control. He bought enough shares to push for change, to unlock value that management was ignoring. The beautiful thing about this 3-pronged approach is diversification of return streams. When the market is rising, the generals do well. When the market is volatile or falling, the workouts and controls provide ballast. The portfolio isn't perfectly correlated with market movements. Warren has engineered a return stream that's smoother, more consistent, more reliable than just buying undervalued stocks and hoping. But he's also doing something else, something harder to quantify. He's saying no, constantly, emphatically, without regret. The 1960s are a frothy time for stocks. Go-go funds are racing to buy the hottest growth stocks. technology companies, conglomerates, anything with a story, anything with momentum. The market doesn't care about earnings or assets or Graham's principles. The market cares about narrative and excitement and which stocks are going up. Warren ignores all of it. He doesn't buy growth stocks trading at 50 times earnings. He doesn't chase momentum. He doesn't worry about missing out on the hot names everyone is discussing at cocktail parties. He sticks to his circle of competence, companies he understands, prices that make mathematical sense, businesses where he can calculate intrinsic value with reasonable confidence. This discipline costs him in the short term. Some years, particularly in the mid-1960s, the partnership lags the market, not by much, and not on a cumulative basis. But in individual years when speculation is running wild, Warren's conservative approach looks slow, boring, out of touch. He writes about this in his annual letters, explains to his partners that he's not trying to maximize returns in any single year. He's trying to achieve good returns over long periods with minimal risk of permanent loss. He's trying to protect their capital first, grow it second. If they want maximum excitement, maximum upside, they should invest elsewhere. If they want steady compounding with someone who's more worried about not losing than about winning, they're in the right place. Most partners stay. Some leave. Warren doesn't chase the ones who leave. He's building something specific, a machine for compounding capital at high rates with low risk over long periods. If someone wants something different, that's fine. There are thousands of money managers out there. Only one Warren Buffett. The office is still the house on Underwood Avenue. Still just Warren and a phone and annual reports. No analysts, no research team, no Bloomberg terminals or real-time data feeds. Warren reads, he thinks, he calculates, he makes decisions. The simplicity is intentional. More people means more meetings, more coordination, more compromise. Warren doesn't want any of that. He wants to sit quietly and think about businesses and make decisions without distraction. His social life is limited. He goes to the office, which is his house, then comes home, which is his office. He has dinner with Susie and the kids. He reads more annual reports. He goes to bed. Weekends are the same. He's not suffering. This is the life he wants. This is flow state for him. Complete immersion in the thing he's built to do. Susie manages everything else. The household, the kids, the social obligations. She's warm where Warren is reserved, empathetic where he's analytical. She collects people the way Warren collects undervalued stocks. The house is always full of friends, musicians, people who need help. Warren floats through these gatherings like a friendly ghost, pleasant but distant, usually thinking about some company he's analyzing. The partnership keeps growing. By 1965, assets exceed $26 million. By 1967, over $65 million. The investor base expands beyond Omaha. People from both coasts, wealthy families looking for someone who can actually compound their capital faster than the market. Everyone wants in. Warren starts turning people away. He limits the size, closes to new investors. He's not trying to maximize assets under management. He's trying to maximize returns. And as the partnership grows, it gets harder to find investments large enough to move the needle, but still meeting his criteria. This is a real problem. When you're managing $100,000, you can buy tiny companies trading below liquidation value and generate huge returns. When you're managing $65 million, those opportunities are too small to matter. You need bigger ideas, bigger companies. But bigger companies are more efficiently priced. Harder to find at genuine bargains. Warren starts buying larger positions in larger companies. He starts using the control strategy more. If he can't find enough passive investments at attractive prices, he'll buy enough stock to influence management, to unlock value actively, rather than waiting for the market to recognize it passively. One of these control investments is a textile company called Berkshire Hathaway. It's cheap, really cheap. Trading for less than working capital, the kind of cigar butt Graham would have loved. Warren starts accumulating shares in 1962. He's planning to do what he did with Sanborn: buy enough to matter, push for changes, extract value, move on. But something goes wrong. The management, specifically a man named Seabury Stanton, negotiates a deal with Warren to buy back his shares. They agree on a price. Then Stanton sends an offer for slightly less than the agreed amount. It's a small difference, 1/8 of a point per share. Nothing material. But Warren is furious, not about the money, about the principle. They had a deal. Stanton is trying to chisel him, to take back a tiny piece of what was agreed. It's disrespectful. It's wrong. And Warren doesn't forgive it. Instead of selling, Warren buys more, a lot more. He buys control. He takes over the board. He fires Stanton. And then, because he now controls this textile company, he has to figure out what to do with it. This is a mistake. Warren knows it's a mistake, even as he's making it. Berkshire Hathaway is a terrible business. The textile industry is in decline. Low margins, intense competition, imports from Asia, no competitive advantages. It's exactly the kind of business Warren should avoid. But he's angry and stubborn, and he's going to prove a point. The point costs him millions, maybe billions, because instead of putting that capital into better businesses, he's stuck with a declining textile mill. He'll spend years trying to manage it, to squeeze out enough cash flow to fund better investments, to turn a bad business into a vehicle for buying good ones. In hindsight, buying Berkshire Hathaway is one of the worst investment decisions Warren ever makes. But it's also one of the most important. Because that mistake, that bad business he bought out of spite, becomes the corporate structure he uses to build one of the most valuable companies in the world. But we're getting ahead again. It's still the mid-1960s. Warren is running the partnership, generating incredible returns, learning what works and what doesn't, building a reputation that will eventually make him the most famous investor in history. And he's about to meet someone who will change how he thinks about everything, someone who will challenge Graham's philosophy, push Warren to think about quality over price, teach him that it's better to buy a wonderful business at a fair price than a fair business at a wonderful price. His name is Charlie Munger, and their partnership will reshape American capitalism in ways neither of them can imagine yet. Chapter 7: The Textile Mill. Picture a factory floor in New Bedford, Massachusetts in 1965. The looms are running, the air thick with cotton dust, the noise deafening. Workers tend machines that were state-of-the-art in 1920, but are obsolete now, in the middle of the 1960s. This is Berkshire Hathaway. This is the company Warren Buffett now controls. This is his mistake, made physical. The numbers that looked good on paper, assets exceeding the stock price, working capital trading at a discount, tell only part of the story. The rest of the story is written in the economics of a dying industry. Textile manufacturing in New England is being undercut by mills in the South, where labor is cheaper. Those southern mills are being undercut by imports from Asia, where labor is cheaper still. Berkshire Hathaway isn't just competing on thin margins. It's competing against geography and history and economic forces that cannot be reversed. Warren fired Seabury Stanton in 1965, took control of the board, installed Ken Chase, a mill manager he trusted, to run operations. Chase is competent. Honest. He understands the business, but understanding a business and making it profitable are different things when the fundamental economics are broken. The textile operations lose money, not every quarter, not every year, but consistently over time. Warren keeps them running because closing them would mean putting thousands of people out of work. He's not sentimental about business, but he's not cruel either. He gives the mills every chance to succeed. He invests in new equipment. He tries different products. He looks for niches where Berkshire can compete. Nothing works. Or rather, things work for a while, generate small profits, then stop working when competition intensifies, or costs rise, or customer needs shift. It's like running on a treadmill that's slowly speeding up. No matter how hard you work, you fall further behind. But Berkshire Hathaway has something valuable. It has float, not from textiles, from a small insurance company called National Indemnity that Berkshire acquired in 1967 for $8.6 million. Warren bought it from a man named Jack Ringwalt, who was retiring and wanted to sell his company to someone who would treat it well. National Indemnity writes unusual insurance policies, the kind other companies don't want to touch. High-risk situations, one-off deals, the premiums are substantial, the losses are unpredictable. But if you're disciplined about underwriting, if you only take risks where the premium adequately compensates for the potential loss, you can make money. More importantly, you get float. Insurance float is beautiful. Customers pay premiums up front. Claims get paid later, sometimes much later. The gap between receiving premiums and paying claims creates a pool of money that belongs to the policyholders, not to you, but that you get to invest. If you can invest that money well, and if you can write policies at an underwriting profit or a small loss, you have a perfect machine for compounding capital. Warren understands this immediately. He's been studying insurance companies since his Geico deep dive in the Graham Newman days. He knows the model. He knows the potential. National Indemnity is small, but it's a platform, a vehicle, a way to generate investment capital without having to raise it from outside investors. The Buffett Partnership still exists, still generates extraordinary returns. But Warren is starting to think about the future. He's 37 years old. He's wealthy. The partnership is getting too large to manage efficiently. The market is overheated. Stocks are trading at valuations that make no sense to him. He's finding fewer and fewer investments that meet his criteria. And he's tired. Not physically tired, mentally tired. Tired of explaining to partners why he's not buying the hot stocks. Tired of the expectations, tired of the pressure to keep beating the market by enormous margins every single year. He's compounded the partnership's capital at nearly 30% annually for 13 years. He's made his partners rich. He's made himself rich, but the opportunities are drying up. In 1967, he writes to his partners with a warning: the market is overvalued. Speculation is rampant. He's having trouble finding good investments. His returns will likely be more modest going forwards. He won't compromise his standards to chase performance. If they want to stay, fine. If they want to leave, he understands. Some leave, most stay. But Warren is already thinking about an exit, not from investing, from running a partnership with outside investors who need regular updates and have the expectations, and sometimes panic when things don't go their way. Berkshire Hathaway offers an alternative structure. It's a corporation, a public company. Warren can use it as an investment vehicle. Instead of returning capital to partners and having them pay taxes, he can retain earnings inside Berkshire and reinvest them without triggering tax events. He can make long-term decisions without worrying about redemptions. He can build something permanent. But first, he has to fix the textile problem, or at least contain it. The mills keep hemorrhaging cash. Every year, Warren considers closing them. Every year, he decides to give them one more chance. The workers are loyal. They've been with the company for decades. Many are immigrants who came to America for these jobs. Warren feels responsible. This goes on for years. The mills lose money. The insurance business makes money. Warren uses the insurance profits to buy stocks. The stocks do well. Berkshire's book value grows. But underneath, the textile business is a slow-motion disaster. A weight dragging down what could otherwise be a spectacular compounding machine. Ken Chase does everything possible. He's a good manager. But good management can't overcome bad economics. By the early 1980s, Warren finally accepts the inevitable. The textile business has to close. He's poured millions into it, delayed the closure for years. But the losses are accelerating. The competition is overwhelming. There's no path to profitability. In 1985, 20 years after Warren took control, Berkshire Hathaway closes its textile mills. The workers are devastated. Some have been there for 40 years. Warren offers severance, tries to help people find new jobs. But there aren't many jobs in New Bedford for 60-year-old textile workers. The closures hollow out a community. Warren later calls Berkshire Hathaway the dumbest stock I ever bought. He means it. The opportunity cost is staggering. Every dollar locked up in those failing textile mills was a dollar that couldn't be invested in better businesses. If he'd put that capital into See's Candies or Coca-Cola, or any of the great businesses he eventually buys, it would have compounded at 20% or 30% annually, instead of declining by 5% or 10%. But here's the paradox. Buying Berkshire Hathaway was a terrible investment decision and a brilliant structural decision. The corporate vehicle, the public company with permanent capital and no redemptions, becomes the platform for everything Warren builds over the next 50 years. Without Berkshire, Warren is just a very successful money manager. With Berkshire, he's something else, a builder of a different kind of conglomerate, a capital allocation machine with no expiration date. The lesson Warren takes from the textile mill isn't about avoiding bad businesses. He already knew that. The lesson is more subtle. It's about the importance of culture and structure and alignment of interests. The partnership structure forced Warren to show results every year. The corporate structure lets him think in decades. And by the mid-1960s, Warren is starting to think differently about what kinds of businesses deserve capital. He's moving away from Graham's cigar butts, moving towards something else, something better. He just needs someone to help him see it clearly. Someone who thinks about businesses differently, who values quality over price, who understands moats and competitive advantages and the power of brand and culture. Someone who will push Warren to evolve beyond his teacher's methods. That someone is already in his life. They've met at a dinner party in Omaha. They've started talking. Slowly, incrementally, their conversations are changing how Warren thinks about investing. His name is Charlie Munger, and the partnership between these two men will transform not just Warren's approach to investing, but the entire landscape of American business. Chapter 8. The Charlie Munger Effect. They meet at a dinner party in Omaha in 1959. Warren is 28. Charlie Munger is 35. Charlie is a lawyer from Los Angeles, in town to handle his father's estate. Someone, a mutual friend, thinks they should meet, thinks they might have something to talk about. That's an understatement. They talk for hours about businesses, about investing, about how to think about value and price and quality. They discover they read the same books, think in similar patterns, use the same mental models. Charlie is taller than Warren, more acerbic, more willing to express strong opinions. But underneath, they're recognizing something in each other, a kinship, a shared way of seeing the world. Charlie Munger isn't like Warren in background. He grew up in Omaha, yes? Worked at Buffett's Son grocery store as a teenager, even though he didn't know Warren then. But Charlie left Nebraska young, went to the University of Michigan, dropped out to serve in World War II, ended up at Harvard Law School without ever finishing his undergraduate degree, became a lawyer in Los Angeles, made partner at a prestigious firm. But Charlie doesn't want to be a lawyer. Not really. He wants to be rich. And he's realized, by watching clients, that lawyers who work by the hour stay comfortable but rarely get wealthy. Real wealth comes from ownership, from equity in businesses, from compounding capital over time. So Charlie is doing what Warren did in the 1950s. He's running a small investment partnership on the side while practicing law. The returns are extraordinary, better than Warren's actually in the early years, but also more volatile. Charlie is willing to concentrate, to bet big when he thinks he's right. He doesn't share Warren's obsession with margin of safety. He's more aggressive, more willing to pay up for quality. After that first dinner, they stay in touch. Not constantly, but regularly. Phone calls, letters, visits when Charlie is in Omaha. They're both analyzing the same companies, looking at the same opportunities, but reaching different conclusions. Warren, trained by Graham, looks for quantitative bargains, companies trading below book value, below liquidation value, below any reasonable measure of intrinsic worth. The numbers have to work. The margin of safety has to be obvious. Charlie looks for qualitative advantages, strong brands, excellent management, barriers to entry, economic moats. He's willing to pay a fair price, even a full price, for a business that will keep getting more valuable. He'd rather buy a wonderful company at a fair price than a fair company at a wonderful price. This difference matters because Warren, following Graham's approach, keeps buying cigar butts, cheap companies with one puff left. He makes money, but it's labor intensive. He has to keep finding new cigar butts. And as the Buffett Partnership grows, cigar butts large enough to matter become scarce. Charlie sees this before Warren does. He tells Warren directly, "Stop buying bad businesses just because they're cheap. Buy great businesses even if you have to pay up a little. The great businesses will compound for decades. The cigar butts will consume time and energy and capital that could be better deployed." Warren resists at first. He's been trained by the master. Graham's approach works. The track record proves it. Why change what's successful? But slowly, incrementally, Charlie's perspective starts to penetrate, not through argument, through examples, through specific situations where Charlie's approach produces better results. There's See's Candies, a California chocolate company, family-owned, iconic brand, loyal customers, strong economics. In 1972, the owners want to sell. They want $30 million. The company is earning only about $4 million annually. That's not cheap by Graham standards. That's paying 7.5 times earnings for a candy company. Warren hesitates. It's too expensive. By his criteria, by Graham's criteria, you don't pay 7 times earnings. You pay 3 times earnings. Maybe 4 if there's growth. 7 is too much. Charlie argues the other side. See's isn't just a candy company. It's a brand, a California institution. They can raise prices without losing customers because people don't buy See's for the price. They buy it for the experience, for nostalgia, for the distinctive white boxes. That pricing power is worth a premium. That moat around the business, the brand loyalty, is worth more than the current earnings suggest. Warren listens, thinks, calculates. He offers $25 million. The owners accept. Blue Chip Stamps, a company controlled by Warren and Charlie, buys See's Candies in 1972. It's one of the best investments Warren ever makes. See's generates enormous cash flows for decades. The business requires almost no capital investment. No new factories, no massive inventories. Just raw materials, labor, and the brand. Warren takes the excess cash and reinvests it in other businesses. See's becomes a money machine, not because it grows dramatically, it doesn't, but because it throws off cash that compounds when deployed intelligently elsewhere. This is the lesson. This is what Charlie has been trying to teach Warren. A great business at a fair price beats a fair business at a great price, because the great business keeps improving. The returns compound. You don't have to sell and search for the next opportunity. You just hold and collect the cash and redeploy it. Warren begins to see businesses differently. He starts looking past the balance sheet, past the hard assets. He starts valuing the intangibles: brand, culture, competitive position, management quality, the things that don't show up in a gram screen, but that determine whether a business will be more valuable in 10 years or less valuable. Charlie is teaching Warren to think like an owner, not just an investor. An investor buys something cheap and sells it when it reaches fair value. An owner buys something good and holds it while it compounds. The owner's mindset is more patient, more focused on long-term economics, more interested in the quality of the business than the price of the stock. This evolution doesn't happen overnight. It takes years. Through the 1970s, Warren is still buying some cigar butts, still using Graham's methods when opportunities arise. But he's increasingly focused on quality, on businesses he can hold forever, on companies that don't just return capital but grow it. Charlie influences Warren in other ways too. He broadens Warren's thinking beyond stocks, real estate, private businesses, operating companies. Charlie himself is doing this in Los Angeles, building a small conglomerate through his law firm and investment partnership, buying apartment buildings, buying stakes in newspapers, building wealth through ownership of real assets, not just marketable securities. They talk about life, not just business. Charlie is more philosophical than Warren. He thinks about psychology, about bias and irrationality, and how most people make decisions. He's influenced by Benjamin Franklin, by Charles Darwin, by his own observation of human nature. He's building what he calls a latticework of mental models, ways of thinking borrowed from different disciplines that combine to produce better decisions. Warren absorbs this. He's always been rational, but Charlie makes him more systematically rational, more aware of his own biases, more thoughtful about second-order effects and unintended consequences. They make each other smarter, better investors, better thinkers. In 1975, Charlie closes his investment partnership and joins Berkshire Hathaway as vice chairman, not as an employee in the traditional sense. Charlie is still based in Los Angeles, still runs his own investments, but he and Warren are now formally partners in Berkshire. Every major decision gets discussed between them. Every acquisition gets debated. They argue, they disagree, they push each other. Warren later says Charlie did more to shape his thinking than any other person, except Benjamin Graham. That Charlie took him from being a good investor to being a better investor, from someone who could compound capital to someone who could build an enduring business. The partnership works because they're different. Warren is more optimistic, more patient, more willing to give management the benefit of the doubt. Charlie is more skeptical, more willing to walk away from deals, more focused on avoiding mistakes than on maximizing upside. Together, they're better than either would be alone. Warren's optimism is tempered by Charlie's skepticism. Charlie's impatience is moderated by Warren's patience. They argue toward the truth rather than away from it. Neither has an ego about being right. Both care more about making good decisions than about proving they're smart. By the late 1970s, Berkshire Hathaway is transforming. The textile business is still hanging on, but barely. The insurance business is growing. The investment portfolio is getting larger and more concentrated in high-quality businesses. Warren is buying newspapers, candy companies, furniture stores, not because they're cheap in Graham's sense, because they're good businesses run by good people that will compound value over long periods. This is the Charlie Munger effect. Not just one insight, not just one conversation, but a decade of influence that shifts Warren's entire approach. That takes him from being a great stock picker to being a great capital allocator, from someone who buys stocks to someone who builds a business. And the businesses he's about to build, the investments he's about to make in the 1980s and beyond, will reflect this evolution. He's going to buy Coca-Cola, not because it's cheap, because it's wonderful. He's going to hold it for decades, let the value compound, never sell. But That's coming. Right now, in the mid-1970s, Warren is still in transition, still learning to trust the quality approach over the pure value approach, still finding his way toward the synthesis of Graham's discipline and Munger's focus on excellence. The textile mill is dying, the insurance business is thriving, and Warren Buffett, with Charlie Munger's help, is becoming the investor he was always meant to be. Not just smart, not just disciplined, but wise about what matters in business and what doesn't. That wisdom is about to be tested in the biggest bet of his life. Chapter 9, The Coca-Cola Bet, the spring of 1988. Warren Buffett is 57 years old. He's sitting in his office in Omaha, still modest, still unpretentious, reading the annual report of the Coca-Cola Company. He's read this report before, many times. He's known about Coca-Cola his entire life, drank it as a kid, sold it from a cooler in his neighborhood for a nickel profit per bottle when he was 6 years old. But he's never owned the stock, never seriously considered it. Too expensive, too popular, too obvious. The kind of company everyone knows, which means the kind of company that's probably fully priced. Graham would never buy Coca-Cola. Too high a price-to-book ratio. Too much goodwill on the balance sheet. Too many intangibles. But Warren isn't Graham anymore. He's something else now. Something Charlie Munger helped him become. Someone who understands that price is what you pay and value is what you get. And that sometimes, not often, but sometimes, a wonderful business at a full price is a better investment than a mediocre business at a bargain price. Something happened in 1985 that changed the calculus for Coca-Cola. The company made a catastrophic mistake. They changed the formula, introduced new Coke. The backlash was immediate and fierce. Customers revolted, not politely, passionately, almost violently. They wanted their Coke back, the original Coke, the only Coke that mattered. Coca-Cola reversed course within months, brought back the original formula as Coca-Cola Classic, apologized, moved on. But Warren noticed something in that failure, something important. The intensity of customer loyalty, the emotional connection people had to a soft drink. You can't manufacture that. You can't buy it. You earn it over decades, over a century by being consistently present in people's lives. That brand loyalty is a moat, not a metaphorical moat, a real economic barrier that protects the business from competition. Someone can make a cola that tastes like Coca-Cola, maybe even tastes better, but they can't make people feel about their cola the way people feel about Coke. That feeling, that attachment, is worth something. Worth a lot, actually, when you calculate it properly. Warren starts buying Coca-Cola stock in 1988. Not a little. A lot. Over the course of the year, Berkshire Hathaway accumulates more than $1 billion worth of Coca-Cola shares. It's the largest investment Warren has ever made in a single company. The largest bet he's ever placed on a brand, on intangibles, on something you can't touch or measure, with traditional value investing metrics. Wall Street notices. Some analysts are confused. Coca-Cola isn't cheap. The P/E ratio is above the market average. The stock has already had a good run. Why is Warren Buffett, the value investor, the disciple of Benjamin Graham, buying an expensive consumer products company? Because Warren sees something they don't. He sees the global opportunity. Coca-Cola is famous in America, ubiquitous in America. But the rest of the world is just beginning to open up. The Berlin Wall is still standing, but not for much longer. China is opening its economy. India is liberalizing. Billions of people who have never tasted Coca-Cola are about to enter the consumer class. And Coca-Cola is positioned perfectly. They have the brand. They have the distribution. They have the concentrate business model, which is almost magical in its economics. Coca-Cola doesn't bottle the drinks themselves in most places. They manufacture the concentrate, the secret formula, and sell it to bottlers who add water and sugar and carbonation and package it and distribute it. The capital requirements for Coca-Cola are minimal. They don't need factories in every country. They don't need massive infrastructure. They need a few plants making concentrate and relationships with local bottlers. The bottlers take all the capital risk. Coca-Cola takes the profits. This is the kind of business Charlie taught Warren to love. High returns on capital, minimal reinvestment needs, pricing power, a brand that gets stronger over time rather than weaker, a product that people buy repeatedly, creating predictable cash flows that compound. Warren does the math. If Coca-Cola can grow internationally the way it grew in America, if per capita consumption in China or India reaches even a fraction of American levels, if the brand maintains its strength and the company executes reasonably well, then the value in 10 years, in 20 years, will dwarf the current stock price. He's not buying Coca-Cola for next quarter's earnings. He's buying it for the next 20 years of earnings, for the compounding effect of billions of people, year after year, choosing Coca-Cola over alternatives, for the cumulative value of 1 billion small transactions repeated over decades. The investment works spectacularly. By the late 1990s, Berkshire's Coca-Cola stake is worth more than $13 billion, a 13-fold return in a decade, not from speculation, not from trading, from owning a piece of a great business and letting that business compound value. But the deeper significance isn't just the return, it's what the investment represents. Warren has completed his transformation. He's moved from Graham's quantitative value investing to something more nuanced. A synthesis of Graham's discipline, the refusal to overpay, the insistence on margin of safety, with Munger's focus on quality and long-term compounding. The Coca-Cola investment becomes a template. Warren starts looking for similar businesses, companies with strong brands, high returns on capital, minimal reinvestment needs, pricing power, businesses that will be more valuable in 10 years almost, regardless of short-term economic conditions. He finds them. American Express, after a scandal, drives the stock down. Gillette, the razor company with pricing power and international expansion potential. Wells Fargo, after the savings and loan crisis. These aren't cigar butts. These are crown jewels temporarily available at reasonable prices. Warren's approach to these investments is different from his earlier style. He's not looking for liquidation value. He's looking for businesses he never has to sell. Businesses that will compound value internally, throwing off cash he can redeploy elsewhere. He's building a collection of extraordinary businesses, each with a moat protecting it, each generating returns that exceed the cost of capital. The Coca-Cola investment also teaches Warren something about patience. The stock doesn't go straight up. It has bad years. The company makes mistakes. Management sometimes disappoints. But the fundamental value proposition, billions of people wanting Coca-Cola, doesn't change. The moat doesn't erode. So Warren holds, through volatility, through criticism, through periods when other stocks are doing better. He explains this in his annual letters to Berkshire shareholders. He's not measuring success by quarterly returns or annual returns. He's measuring it by whether the businesses he owns are more valuable than they were 5 years ago, 10 years ago, by whether the moats are widening or narrowing, by whether the returns on capital are staying strong. This long-term focus is unusual on Wall Street. Most investors, most fund managers, are evaluated quarterly. They have to show results every 90 days. They can't afford to underperform for a year, let alone several years. The pressure to do something, trade, rotate, reposition, is constant. Warren doesn't have that pressure. Berkshire is a public company, but Warren controls it. He doesn't answer to outside investors who can redeem at the end of the quarter. He doesn't have a boss second-guessing his decisions. He's built a structure that allows him to think in decades while everyone else is thinking in quarters. The Coca-Cola bet validates this structure, proves that patience, combined with quality, produces extraordinary results. That if you buy a piece of a wonderful business at a reasonable price and hold it while the business grows, you'll do better than almost any other approach. By the late 1980s, Warren's reputation is shifting. He's no longer just the value investor from Omaha. He's something bigger, an oracle, someone who understands business at a deeper level than almost anyone else. Companies want him as an investor because his involvement validates their quality. Managers study his annual letters like scripture, looking for insights. But Warren's success is about to be tested in a different way, not by market downturns or bad investments, by a crisis, a real crisis, the kind that threatens to destroy a major financial institution and requires someone to step in and fix things. The kind that will test whether Warren's principles work not just in buying businesses, but in saving them. That crisis is coming. It's 1991, and a Wall Street investment bank called Salomon Brothers is about to implode. Chapter 10. The Salomon Crisis. The phone rings on a Saturday night in August 1991. Warren is at home in Omaha. On the line is John Gutfreund, the chairman of Salomon Brothers, one of Wall Street's most prestigious investment banks. Salomon is in trouble. Serious trouble. The kind that could destroy the firm within days. Here's what happened. A Salomon trader named Paul Moser has been submitting false bids in Treasury auctions, rigging the market, breaking federal laws. The Treasury Department has discovered this. The Securities and Exchange Commission is investigating. The Federal Reserve is threatening to bar Salomon from the government securities market, which would effectively shut down the firm's core business. Gutfreund knew about the violations months earlier, did nothing. Now the scandal is public. The board is in crisis. And they need someone with credibility, someone the regulators trust, to step in and fix the situation. They're asking Warren to become interim chairman, to leave Omaha, move to New York, take over daily management of a firm with 8,000 employees and billions of dollars in positions, to save Salomon Brothers from collapse. Warren is 60 years old. He's never managed a Wall Street firm. He's never worked in investment banking. He's an investor, not an operator. Not this kind of operator, anyway. He runs insurance companies and owns pieces of businesses. He doesn't trade bonds or manage trading desks or deal with regulators investigating the criminal activity. But he's also a major Berkshire shareholder in Salomon. Berkshire owns $700 million in Salomon preferred stock. If Salomon fails, Berkshire loses that investment. More importantly, the failure could damage the entire financial system. Salomon is too interconnected, too important. Its collapse would ripple through markets, hurt innocent parties, cause collateral damage Warren can't tolerate. He agrees. On one condition: complete authority, no second guessing, no board members or executives undermining his decisions. If he's going to fix this, he needs control. The board agrees. They have no choice. Warren flies to New York on Sunday, walks into Salomon's offices in Lower Manhattan on Monday morning. The trading floor is massive. Hundreds of traders staring at screens, shouting orders, moving billions of dollars around. They look up when Warren walks in. This rumpled guy from Omaha in an off-the-rack suit, their new boss. Warren addresses the entire firm. He's blunt. The firm broke the rules, broke the law. People who knew about it and said nothing have resigned or been fired, including Gutfreund, including the general counsel. The old regime is gone. Warren is in charge now, and the rules going forward are simple. Lose money for Salomon, and Warren will be understanding. Lose Salomon's reputation, and Warren will be ruthless. Reputation is everything. It takes decades to build and minutes to destroy. They're going to rebuild it by being completely honest with regulators, with clients, with each other. No cutting corners. No clever interpretations of rules. If something seems wrong, it probably is. Don't do it. This is classic Warren. Reduce complex situations to simple principles. Make the values explicit. Communicate them clearly. Then trust people to follow them or remove the ones who won't. He spends the next 9 months living in New York, working 16-hour days, meeting with regulators, with Treasury officials, with the Federal Reserve, with prosecutors, with clients who are threatening to pull their business, with employees who are terrified they're about to lose their jobs. The Treasury Department is furious. Rightfully so. Salomon's trader rigged Treasury auctions, made the market less efficient, broke the integrity of the system. They want to punish Salomon severely, maybe fatally. Warren negotiates, not by making excuses, by acknowledging everything. Yes, Salomon screwed up. Yes, the violations were serious. Yes, people need to be held accountable. But punishing 8,000 employees and hundreds of clients for one trader's crimes and management's negligence would be unjust, would hurt innocent parties more than it would deter future violations. He's persuasive because he's credible. The regulators know Warren, know his reputation, know he's not defending Salomon because he profits from defending them. He's defending them because destroying them would cause more harm than good. The Federal Reserve decides not to bar Salomon from the government securities market. The Treasury accepts a settlement. Salomon pays fines, agrees to reforms, survives. Warren has saved the firm. But the experience changes him. He sees how quickly things can fall apart when people cut ethical corners. How fragile trust is in financial systems. How much damage can be done by people who think they're being clever, who think rules don't apply to them, who think they won't get caught. He also learns something about himself. He can operate under pressure, can make tough decisions quickly, can manage complex organizations when necessary, but he doesn't enjoy it. This isn't what he's built for. He's built for thinking about businesses and allocating capital, not managing crises and navigating political situations. When Salomon stabilizes, Warren steps down as chairman, returns to Omaha, goes back to his normal routine, reading annual reports, thinking about investments, living simply. The Salomon crisis is over. Berkshire's investment eventually gets repaid with interest. The firm survives long enough to be acquired by Travelers Group in 1997. But the lessons stay with Warren. The importance of culture, of hiring people you trust completely, of being absolutely clear about values, of walking away from situations where the ethics are murky or the people are cutting corners. He becomes more careful about where Berkshire invests, not just whether a business has a moat, whether the people running it have integrity, whether they'll protect the reputation Warren has spent his entire life building. Because reputation is the ultimate moat. Lose it, and nothing else matters. The Salomon crisis also raises Warren's profile in a different way. He's not just a great investor anymore. He's someone who can be trusted in a crisis. Someone with judgment and authority and credibility. Someone the system can call on when things go wrong. This reputation will serve him in the decades ahead. When financial crises hit, when companies need capital during panics, when the market is falling apart and people are scared, Warren becomes the person everyone wants to hear from. The calm voice, the steady hand, the rational thinker, when everyone else is emotional. But right now, in the early 1990s, Warren is just glad to be home. Back in Omaha, back to his routine, back to thinking about businesses instead of managing scandals. And he's about to meet someone who will become one of his closest friends. Someone who thinks about the world as systematically as Warren does, but from a completely different domain. Someone who will teach Warren about technology and network effects and exponential growth, someone named Bill Gates. And their friendship will shape the next chapter of both their lives in ways neither of them expects. Chapter 11, The Microsoft Dinner. The invitation comes in 1991. Warren's friend Meg Greenfield, an editor at the Washington Post, is hosting a small dinner. She wants Warren to meet Bill Gates. Warren resists. He doesn't do technology, doesn't understand it, doesn't invest in it. What would he and Bill Gates possibly have to talk about? Meg insists. Just come for an hour, she says. If you're bored, you can leave. Warren agrees reluctantly. He shows up expecting to make polite conversation for 45 minutes and then escape back to his hotel. Bill Gates shows up expecting roughly the same thing. He's 35 years old, already one of the richest people in the world. Microsoft dominates personal computer software. Windows is everywhere. But Bill knows Warren's reputation, knows he doesn't invest in technology. Figures this will be an awkward dinner where they have nothing in common. They sit down, start talking. The conversation immediately goes somewhere neither of them expected. Warren asks Bill about Microsoft's competitive advantage. What protects the business? Why can't someone else just copy what Microsoft does? Bill explains about network effects, about how every new person who uses Windows makes Windows more valuable to everyone else. Developers write software for Windows because that's where the users are. Users choose Windows because that's where the software is. It's a reinforcing cycle, a moat that gets wider the more successful you become. Warren understands this instantly. It's the same principle as Coca-Cola, just in a different domain. Coca-Cola's moat is brand and distribution and emotional connection. Microsoft's moat is installed base and network effects and switching costs. Different mechanisms, same economics. A competitive advantage that compounds. Bill asks Warren about business principles, about how to think about allocating capital, about the difference between growth for its own sake and growth that creates value. Warren explains about return on invested capital, about how the best businesses are the ones that can grow without requiring massive reinvestment. That throw-off cash you can use for other things. Bill realizes Warren is describing Microsoft. They don't need factories, don't need inventory. They write software once and sell it millions of times. The incremental cost of each additional copy is essentially zero. The returns on capital are astronomical. They're speaking the same language, not about technology versus traditional business, about fundamental principles, about competitive dynamics, about how to think clearly about complex systems. The hour Warren planned to stay turns into 3 hours, then 4. They barely touch their food. Meg watches them with satisfaction. She knew. Somehow she knew these two would connect. They talk about education, about philanthropy, about what makes organizations effective or dysfunctional, about how to maintain culture as companies scale. Warren describes Berkshire's decentralized structure. Bill describes Microsoft's culture of debate and intellectual honesty. They're both building organizations around ideas more than hierarchy, around getting decisions right more than preserving ego. Warren asks Bill what he worries about. Bill says antitrust. The government is already investigating Microsoft. Worried about monopoly power. Worried about Microsoft's dominance. Bill doesn't think Microsoft has done anything wrong. They just built better products. But he knows perception matters in politics. Warren gets this. He lived through the Salomon crisis, learned that technical correctness isn't enough, that how things look matters as much as how they actually are. He advises Bill to be careful, to think about optics, to realize that success creates enemies and responsibilities. At the end of the evening, they exchange information, promise to stay in touch. Neither of them knows if it will actually happen. Rich people promise to stay in touch all the time. Usually it's polite fiction. But Warren and Bill actually do stay in touch. They start calling each other, meeting when they can, playing bridge together. They're both fanatics about bridge. Bill visits Omaha, Warren visits Seattle. Their friendship deepens. What's remarkable about the friendship is how much they teach each other. Warren teaches Bill about capital allocation, about the importance of focusing on a few things rather than spreading yourself thin, about the power of saying no to good opportunities so you can say yes to great ones, about thinking in decades rather than quarters. Bill teaches Warren about technology, not the technical details. Warren still doesn't want to learn how computers work, but about the business models, about how technology companies scale differently from traditional businesses, about network effects and platform dynamics, and how software eats the world. Warren still won't invest in technology companies. He sticks to his circle of competence, buys things he understands. Bill respects this, doesn't push Warren to buy Microsoft stock, understands that having principles means following them even when opportunities seem attractive. But the conversations influence Warren in subtle ways. He starts thinking more about intangible assets, about how value is created in businesses that don't make physical products, about competitive advantages that exist in network effects and ecosystems rather than just brands and distribution. This thinking will matter later. When the internet boom happens in the late 1990s, when everyone is buying technology stocks at insane valuations, Warren will refuse to participate, will be criticized for being old-fashioned, for not understanding the new economy. His friendship with Bill, his understanding that technology creates real value, makes the criticism harder. Because Warren isn't rejecting technology. He's rejecting valuations that don't make mathematical sense. Bill defends Warren during this period, tells people that Warren's approach is right, that most of these internet companies have no moats, no sustainable advantages, that they're trading on story and momentum rather than economics, that when the bubble bursts, and it will burst, Warren will be proven correct. The bubble does burst. In 2000, the NASDAQ crashes. Hundreds of billions in market value evaporate. Companies that seemed invincible go bankrupt. Investors lose fortunes. Warren, who sat out the entire boom, looks prescient, not because he predicted when the bubble would pop, but because he understood the fundamentals didn't support the prices. The friendship between Warren and Bill becomes one of the defining relationships in both their lives. They vacation together, play bridge for hours, talk on the phone regularly. When Bill's mother becomes ill, Warren is there. When Warren's wife Susie dies in 2004, Bill is there. But the friendship isn't just personal, it's intellectual. They're both fascinated by how the world works, by systems and incentives and decision-making. They read the same books, recommend ideas to each other, challenge each other's thinking. And in the mid-2000s, they start talking about something else, about what to do with their wealth, about responsibility and legacy, and what it means to have more money than you could ever spend. Bill and his wife Melinda have started the Gates Foundation. They're thinking systematically about philanthropy, about how to identify the highest impact interventions, about global health and education and poverty. They're applying the same analytical thinking to giving that they applied to business. Warren is thinking about the same questions. He's always known he'll give away his fortune eventually. But to whom? How? When? He's been deferring these decisions, letting the money compound, figuring the longer he waits, the more he'll have to give. Bill and Melinda are doing something different, giving while they're alive, actively involved, measuring results, learning what works. It's appealing to Warren. The idea of deploying capital philanthropically with the same rigor he deploys it in business. They start talking seriously. What if Warren didn't start his own foundation? What if he gave the bulk of his fortune to the Gates Foundation? Let them deploy it. Use their infrastructure, their research, their expertise. He could stay focused on what he does best, compounding capital, while they focus on what they do best, deploying it for maximum impact. It's an unusual idea. Most billionaires want foundations with their own names. Want control? Want the prestige and recognition? Warren doesn't care about any of that. He cares about impact, and he trusts Bill and Melinda to achieve more impact than he could on his own. This thinking will eventually lead to one of the largest philanthropic commitments in history. But that's still ahead. Right now, in the 1990s and early 2000s, Warren and Bill are just two friends learning from each other, playing bridge, talking about business and life and how to think about the world. So the friendship matters because it shows something about Warren that the public sometimes misses. He's not rigid, not stuck in his ways. He's curious, open to new ideas, willing to learn from people who see the world differently. His circle of competence is fixed. He won't invest in things he doesn't understand. But his thinking within that circle keeps evolving, keeps incorporating new insights. Bill Gates teaches Warren that you can have principles and still adapt. That wisdom isn't about knowing everything. It's about knowing what you don't know and learning from people who know what you don't. And soon, Warren is going to make a decision that surprises everyone who thinks they understand him. A decision about his fortune, about what to do with the billions he's accumulated over 6 decades of compounding. A decision that will redefine what it means to be wealthy in America. Chapter 12, The Giving Pledge. The announcement comes in June 2006. Warren Buffett is 75 years old. He's one of the richest people in the world. Berkshire Hathaway stock has compounded at roughly 20% annually for 4 decades. His net worth exceeds $40 billion. He's going to give it all away. Not eventually. Now. While he's alive, he's donating 85% of his Berkshire shares to 5 foundations. The largest portion, about $37 billion at the time, goes to the Bill and Melinda Gates Foundation. Smaller amounts go to foundations run by his children and the Susan Thompson Buffett Foundation, named for his late wife. Wall Street is shocked. Philanthropists usually create their own foundations, put their names on buildings, control how the money is spent. Warren is doing the opposite, giving the bulk of his fortune to someone else's foundation, trusting Bill and Melinda Gates to deploy it more effectively than he could himself. The decision reflects everything Warren believes about capital allocation. He's good at compounding money. Bill and Melinda are good at deploying it philanthropically. Comparative advantage, division of labor, the same principles that work in business work in giving. But there's more to the announcement. Warren isn't just giving away his own fortune. He's challenging others to do the same, explicitly, publicly. He writes an essay explaining his thinking, makes the case that people like him, people with more money than they could ever use, have a responsibility to give most of it back. He doesn't moralize, doesn't guilt anyone, just makes the logical argument. If you have $1 billion and spend $10 million a year, you still have $1 billion. The money compounds faster than you can spend it. At some point, the excess serves no purpose except keeping score. It doesn't make you happier, doesn't make your children's lives better. Actually, leaving them too much probably makes their lives worse. So, why not give it to causes that can actually use it? Bill and Melinda are thinking along the same lines. They've been talking with Warren for years about this, about creating a culture where extreme wealth comes with expectations, not legal obligations, social expectations, where billionaires are expected to give most of their money away and celebrated when they do. In 2010, Warren and Bill make this explicit. They create the Giving Pledge, a public commitment where billionaires promise to give away at least half their wealth during their lifetimes or in their wills. It's not legally binding, just a moral commitment. A public statement of intent. They start by inviting other billionaires to dinners in New York, in California, small gatherings where they can talk candidly about philanthropy and responsibility and what it means to have more money than you need. They make their case, Warren with his folksy charm and mathematical arguments, Bill with his systematic analysis and data. Some people sign immediately. They've been planning to give away their money anyway. The pledge just makes it public, formalizes it. Others are hesitant, worried about their children, about control, about what happens to family businesses, about privacy. Warren addresses these concerns directly. The pledge isn't about the timing or the mechanism. It's about the destination. You can give during life or at death. You can give to your own foundation or to existing charities. You can involve your children or not. The only requirement is that you commit to giving away at least half. Why half? Because it's enough to be meaningful, but not so much that it feels punitive. Warren himself is giving away more than 99%, but he doesn't expect everyone to do that. Half is the floor, the minimum, enough to show you're serious. The giving pledge grows slowly at first. A few dozen billionaires the first year, then more. By 2025, over 240 individuals and families from 29 countries have signed. They represent more than $600 billion in committed philanthropy. Critics point out that the pledge is toothless. No enforcement mechanism. No penalties for backing out. Some signers might never follow through. It's just a PR gesture. A way for billionaires to look good without actually changing anything. Warren doesn't care about the criticism. He's not trying to force anyone to do anything. He's trying to change culture, to make giving the norm rather than the exception, to create social pressure, the good kind, where extreme wealth comes with extreme responsibility. The pledge works because it's public. When someone signs, their name goes on a website. They write a letter explaining their reasoning. They become part of a community, a movement. Walking away from that commitment would be embarrassing, not illegal, just embarrassing. And for most billionaires, that's enough. Warren's own giving continues on schedule. Every year, he donates more Berkshire shares to the Gates Foundation and his family foundations. The shares keep appreciating. He keeps giving them away. His wealth keeps shrinking in relative terms. He's fine with this. More than fine. It's exactly what he planned. He talks about this in interviews, explains that he won the ovarian lottery. Born in the United States in 1930. Male. White. With talents that happen to be extremely valuable in a market economy. If he'd been born in Bangladesh in 1930, those same talents would have generated nothing. He'd have lived in poverty. The accident of birth gave him everything. So giving it back isn't sacrifice. It's rebalancing. Taking the random luck of circumstances and redirecting it toward something useful. Toward reducing suffering. Toward creating opportunities for people who didn't win the lottery. He won. This philosophy influences how Warren thinks about everything. About taxes. He famously points out that his tax rate is lower than his secretary's, which is absurd. About inequality, he acknowledges it's a real problem that market economies tend to exacerbate. About responsibility, he believes people with advantages should use those advantages for more than just accumulating more advantages. But he's not preachy about it, doesn't demand that others share his views, just lives them, gives away his money. Advocates for policies he thinks are right, votes his conscience, and trusts. That example matters more than lecture. The giving pledge becomes part of Warren's legacy. Not the biggest part. That's still Berkshire Hathaway. Still the investment returns. Still the lessons about capital allocation and business quality. But an important part. The part that says success creates obligations. That having more than you need means helping people who don't have enough. Bill and Melinda's marriage eventually ends in 2021. They continue running the foundation together, continue deploying Warren's donations, continue the work they started together. Warren's commitment doesn't change. The trust he placed in them, in their judgment, their integrity, their ability to do good work, remains. By the 2020s, Warren has given away more than $50 billion in Berkshire stock. The shares he's donated are worth more now than his entire net worth was when he made the initial commitment. The compounding continues even as he gives it away. He's running out of money more slowly than the money is growing. It's a race he's happy to lose. The giving pledge hasn't solved wealth inequality, hasn't ended poverty, hasn't fixed the structural problems with how capitalism distributes rewards. Warren doesn't claim it has. He's not naive about what philanthropy can and can't accomplish. But it's changed the conversation, made giving normal among the ultra-wealthy, created expectations that didn't exist before. That matters. Not as much as policy changes would matter, not as much as systemic reform would matter, but it matters. And it reflects who Warren is at his core. Someone who thinks in systems, who understands incentives, who knows that culture matters as much as rules, who believes that you change behavior not by demanding it, but by modeling it, by showing that giving away your fortune can be joyful, satisfying, the best investment you ever make. He's in his 90s now, still running Berkshire, still allocating capital, still writing annual letters, still living in the same house in Omaha he bought in 1958, still eating at the same steakhouse, still drinking cherry Coke for breakfast. But he's also thinking about legacy, about what endures when he's gone. The money will all be given away. The Berkshire shares will eventually belong to charities. His children will be comfortable, but not dynastic. His name will be on some buildings, but that's not what matters to him. What matters is the example, the letters, the principles, the idea that you can succeed wildly in business and still maintain integrity, that you can be wealthy and still be normal, that you can allocate capital brilliantly and still allocate your life toward things that matter beyond money. The giving pledge is part of that. Part of the message Warren is leaving, not just how to invest, how to live, how to think about success and responsibility, and what you owe to the luck that gave you advantages others didn't have. And every year in those annual letters to Berkshire shareholders, Warren continues teaching, continues explaining, continues distilling decades of experience into principles anyone can understand and apply. Those letters have become their own form of philanthropy, wisdom freely given to anyone willing to read. Chapter 13. The Berkshire Annual Meeting. Every spring, Omaha changes its posture. The airport fills with people holding tote bags that say Berkshire Hathaway in block letters like pilgrims carrying a flag. Hotels that are usually quiet become loud with small talk about insurance float and railroad ton miles. Taxi drivers learn to pronounce Munger correctly. Steakhouse reservations vanish. The whole city tilts, for a weekend, toward one strange question. What do the two old men think? They call it an annual meeting, but it behaves more like a festival, a reunion, a classroom with no final exam. Tens of thousands of shareholders arrive from everywhere. Doctors from Seoul, engineers from Bangalore, teachers from Ohio, retirees from Florida, 20-year-olds who bought a single share because they wanted a seat in the room where rationality still feels fashionable. They come early because the weekend starts before the meeting ever begins. On Friday, the convention hall becomes a marketplace of Berkshire's odd little empire. Candy and couches, jewelry and jeans, batteries and books. You can walk past a display of industrial lubricants and then turn a corner into a wall of chocolates. And somehow it all makes sense, because Berkshire has never tried to be elegant. It has tried to be honest. It has tried to own businesses that throw off cash and require little drama. It has tried, in its own quiet way, to build a country inside a company. Shareholders treat the exhibits like landmarks. They make a loop, almost ritualistic. They stop at the candy counter. They buy boxes for people back home, because this is what you do when you've traveled to see an oracle. You bring proof. They stop at the jewelry case. They try on watches they won't buy. They take pictures anyway. They stop at the book table where the titles aren't flashy, just dense and practical. Things about accounting, psychology, compounding, the gentle violence of incentives. This is not the merch stand at a rock concert. It's a portable library. And then there's the other ritual, shopping as shareholder sport. Somewhere across town, a furniture store opens its doors like a stadium. The parking lot fills before sunrise. People line up, not for celebrity, not for a signature, but for a discount. Because Berkshire's culture has always had a certain plain Midwestern suspicion of paying retail when you don't have to. You can call it frugality. You can call it discipline. You can call it a joke that got out of hand and became tradition. But it's also a message. This company doesn't worship luxury. It worships good economics. Then Saturday arrives. It starts early, because the faithful always arrive early. Outside the arena, people in folding chairs drink coffee from paper cups, wearing name badges like conference attendees and ball caps like baseball fans. Some talk quietly, some loudly, and some just sit there with a kind of reverent impatience, as if they're waiting for the lights to come on in a theater that's been dark for their whole life. Inside, there's a hum that feels like electricity without anger. There are no chants, no boos, no tribal jerseys. Just a soft, constant anticipation, like thousands of people leaning forward at the same time. Up front, on a stage that's deliberately plain, 2 chairs wait, a table, microphones, water, nothing else. Because the show has never been the show. The show is the thinking. Before the questions begin, there's often a film. Funny, self-deprecating, stitched together with old clips and new jokes. It's the company reminding everyone that seriousness doesn't require solemnity, that you can manage hundreds of billions and still laugh at yourself. Then Warren walks out, still in Omaha, still in the same city where he delivered papers in the dark, still wearing the suit that looks like it came from a place where suits are bought for durability, not for impact. He sits down as if he's about to eat breakfast, not address a crowd that could fill a small stadium. Charlie joins him, or in later years, his presence is felt even when his body isn't there in the same way, because a partnership like that doesn't end cleanly. It echoes. It becomes part of the furniture of how a mind works. And then they begin. The questions come from everywhere. Microphones in aisles, voices that tremble, and voices that don't. People who have rehearsed their question for weeks, and people who improvise. People asking about inflation and interest rates, and artificial intelligence, and insurance underwriting, and why a company chose this acquisition instead of that one. The remarkable thing is not that they answer. It's how they answer. Warren doesn't talk like a CEO guarding a stock price. He talks like a man explaining a system to a neighbor over a fence. He admits what he doesn't know. He corrects himself when he misstates a number. He treats a good question like a gift, not a threat. And beneath the charm, beneath the jokes about hamburgers and cherry Coke, and how he still doesn't know what most tech companies actually do, there's always the same operating code. Don't risk permanent loss. Know what you're doing before you do it. Demand a margin of safety, not because you're timid, but because you're humble about the future. If you need to borrow conviction, you don't have conviction. Reputation is worth more than any deal. People think they come for stock tips, but what they're really watching is temperament. They're watching a man refuse to be rushed by the world's impatience. They're watching him explain again and again that the hardest part of investing isn't intelligence. It's the ability to sit still while everyone else is sprinting. Someone asks why Berkshire keeps so much cash. Warren explains patiently that cash is not a failure of imagination. It's an option, a kind of sleeping weapon for moments when panic makes good things cheap. He doesn't say this like a gambler waiting for the next hand. He says it like a lifeguard explaining why he keeps watching the water even when it looks calm. Someone asks about mistakes. He lists them, not as confession, not as performance, but as data. Here's what happened. Here's why it happened. Here's what it cost. Here's what I learned. The crowd laughs sometimes, but the laughter is affectionate, not worshipful. It's the sound of people recognizing that the myth is made of ordinary decisions repeated over decades. Not genius lightning, not secret information, just a stubborn devotion to sense. Hour after hour, the questions continue. The answers continue. The arena stays surprisingly quiet. Thousands of people listening, truly listening, for 6 hours. As if attention is a form of respect, the modern world has almost forgotten how to give. And that's what the Berkshire meeting really is. A rare public celebration of thinking slowly. When it ends, people spill back into Omaha sunlight with the satisfied exhaustion of people who have attended something that felt both simple and profound. They'll talk about one line Warren said, one joke, one analogy, one refusal to overcomplicate. They'll carry it home like a small tool. Not a stock pick, a way of seeing. Because the annual meeting is not a pep rally for a company. It's a yearly reminder that you can build a fortune without lying to yourself. That you can win by being patient. That there's still a place, somewhere in Nebraska, where a man can sit in a plain chair and tell the truth about money for 6 straight hours, and people will fly across the world just to hear it. Chapter 14. The candlelight returns. In the end, it always comes back to a room. Not an arena, not a meeting hall, not a trading floor full of screens. A room with paper, a desk, a lamp that makes a small pool of light on a page. Warren Buffett's life looks from far away like an endless sequence of dramatic numbers. Billions gained, companies acquired, crises navigated, fortunes pledged away. But up close, it looks like this. A man sitting still, reading, turning pages, thinking. The world imagines that wealth is loud, that it arrives with champagne and headlines and the constant glow of attention. But Warren's wealth was built in quiet. In early mornings, in ordinary afternoons, in decades where the most important decisions didn't feel important at the time because they were made without adrenaline. The habit never changes. It only deepens. He is old now, older than the people who first called him an oracle, older than many of the companies he once studied in dusty manuals. The headlines keep coming anyway. New booms, new bubbles, new panics that insist this time is different. And he keeps doing the same thing. He keeps returning to first principles the way a sailor keeps returning to the stars. What is this business? What does it earn? What does it need to earn it? How honest are the people running it? What could go wrong that no one is pricing in? If you can answer those questions, the rest is noise. If you can't answer them, the most beautiful story in the world won't save you. He learned this as a child without knowing he was learning it. Back when he discovered that 5 paper routes is a business and 1 paper route is a job. Back when he felt in his bones that repetition turns small edges into large outcomes. Back when he watched a stock fall from 38 to 27 and learned fear, and then watched it rise and learned a different, more expensive lesson. That impatience has a price tag. He spent his life collecting these lessons the way other people collect souvenirs. Benjamin Graham gave him the margin of safety, the discipline, the skepticism, the refusal to confuse price with value. Charlie Munger gave him the rest, the understanding that the best numbers are often attached to the best businesses, and that the best businesses are often built on things you can't measure cleanly: trust, brand, culture, obsession with customers, a moat made of human behavior. And somewhere along the way, Warren learned that compounding is not only a financial phenomenon, it's a life phenomenon. Reputation compounds. Slowly, quietly, invisibly. Until one day, you realize people believe you before you speak. Friendships compound too. Not through intensity, but through consistency. The calls returned, the time shown up, the presence in the hard years, the steady loyalty that becomes a kind of shelter. And so do mistakes. They compound in the other direction if you refuse to look at them honestly. Pride compounds. Denial compounds. The small ethical shortcut that seems harmless today becomes the habit that ruins you later. Warren understood that part more clearly after Salomon. He understood it in his gut, that you can lose money and recover. But if you lose trust, the math stops working. The world becomes more expensive. Every opportunity comes with hidden fees. This is why his annual letters matter. Once a year, he still sits down and writes as if he's talking to a single person across a kitchen table. He explains what happened. He explains why. He tells you what went right and what went wrong. He doesn't hide the blemishes under marketing language. He doesn't pretend certainty where certainty doesn't exist. It isn't just investor relations. It's teaching. It's a man leaving breadcrumbs through a forest. He walked for nearly a century saying, "Here's what I learned. You can use it if you want." And the strangest part is that the numbers really do tell stories. Not the flashy numbers people brag about, the quiet ones. The steady rise of book value over decades. The widening of an insurance float. The boring, relentless cash flow of a business with pricing power. The cost avoided by walking away from a deal that felt exciting but smelled wrong. The opportunity cost of ego. If you sit with those numbers long enough, they turn into something like a moral. Not money is good or money is evil. Something more practical. Something sturdier. That the world rewards clarity. That patience is not passive. That doing fewer things, doing them well, doing them honestly, beats frantic motion dressed up as progress. And eventually, the circle closes. We return to that small office again, not because the setting is poetic, but because it's true. Because the whole thing, the fortune, the letters, the meetings, the myth, was built in rooms like this, with light on paper and time spent thinking. Outside, the world keeps shouting. Inside, the pages turn. The lamp throws its steady glow.